In a notable escalation of the ongoing trade dispute, China's Ministry of Finance has announced a significant increase in tariffs applied to products from the United States, raising them from 34% to 84%. This move represents a strong retaliation against the recent trade decisions imposed by the United States. In response, President Donald Trump announced his intention to establish an additional 50% tariff on Chinese goods, adding to the previously established levies. The total sum of U.S. tariffs on Chinese imports would thus reach an impressive 104%. Stay ahead of the curve with the latest in tech. Subscribe to Datadollar now and never miss an update on the innovations that are shaping the future of business and technology. Join our community. China responded quickly in the morning, matching its own tariffs to the same 84%, marking a notable jump from the previous 34%. With retaliatory responses on the rise, it seems Trump is searching for a new tactic. However, analysts highlight that this recent turn marks a much more hostile stage in the trade conflict, different from previous economic clashes. On April 9th, President Trump announced a 90-day pause on most tariffs directed at U.S. trading partners, a move that financial markets had already anticipated. The reaction was immediate and positive, with U.S. stock markets recording strong gains. However, this calm was short-lived, as China was excluded from the suspension. Instead of offering relief to Beijing, the administration increased pressure by raising tariffs from 104% to a shocking 125%. China, in turn, quickly responded by increasing its own tariffs on U.S. goods to 84%. But Beijing's response did not stop there. Government officials mentioned the possible adoption of further economic measures capable of altering Wall Street's course and generating greater instability in global markets. In a dramatic twist within this escalating trade war, it has been reported that China is considering unloading a significant portion of its vast holdings in U.S. Treasury bonds, a move some experts describe as an economic atomic bomb. Sources indicated that Beijing could liquidate between $900 billion and $1,100 billion in U.S. debt, sparking great concern in Washington and within the Trump administration. This bold possibility arises amid growing tensions between the world's two largest economies, following a new round of aggressive tariffs from Washington. Both sides are maintaining firm stances, and the potential bond sell-off by Beijing is seen not only as retaliation, but also as a strategic tactic capable of impacting international financial markets. The consequences could be profound. Why is China considering this option? What impact would it have on the U.S. economy? Why are stock markets declining? As the conflict escalates, financial analysts are closely watching what could become a turning point for the global economy. In an environment marked by the resurgence of trade tensions, rumors emerged on April 2, 2025, that Beijing plans to sell a substantial portion of its U.S. bonds, causing a major stir. What was once dismissed as unlikely has gained traction. Widely circulated documents on social media claim that Chinese authorities have ordered the central bank and major financial institutions to reduce dollar purchases. Simultaneously, reports indicate that China has already begun decreasing its participation in Treasury bonds, just as tensions with Washington rise due to tariffs. Analysts are now seriously considering the use of this powerful financial tool China holds, its vast portfolio of U.S. Treasury bonds. Some experts argue that if these holdings were significantly reduced, it could raise the cost of U.S. debt, weaken the dollar, fuel inflation, and shake domestic markets. This strategy, frequently compared online to an economic nuclear bomb, reflects the high stakes of this confrontation. As one of the largest foreign creditors of the United States, China has significant influence over the debt market, and any mass sell-off could be profoundly destabilizing. For years, China has invested part of its trade surplus in these bonds, helping to finance the U.S. deficit while protecting the value of its own reserves. But the imposition of tariffs by President Trump, which have reached up to 104%, seems to have prompted a shift in Beijing's approach. The message now is clear. They are willing to play their strongest card. According to international media reports, Chinese banks have received orders to curb dollar purchases, a signal that China may be reducing its exposure to dollar-denominated assets. The increasing sale of Treasury bonds has exacerbated these concerns. British media reports indicate that this liquidation has driven up yields and generated discontent on Wall Street. In this context, Trump's tariff policy has not only inflamed the trade conflict, but has had a collateral effect on the bond market, which has become the epicenter of anxiety. For years, there has been speculation on social media about China possibly using this strategy, although Beijing had refrained so far due to the risks involved. A large volume sell-off could devalue China's own reserves. Moreover, the complex economic interdependence between the two nations suggests that any such move would likely result in mutual losses. As 2025 progresses, tensions tied to the Trump administration's tariffs seem to have deepened. In a recent announcement, China reported plans to impose a new 84% tariff on US products, indicating that the once strong commercial relationship between the two powers is nearing a serious rupture. Amid this growing conflict, Trump declared that they want to negotiate, but they don't know how to start, and that he is waiting for a call. Meanwhile, Beijing has maintained that the United States must first reduce tariffs, leaving little room for effective negotiations. Against this backdrop, the possibility of China executing a US bond sell-off seems increasingly real. The big question is whether Beijing will actually take this extreme step. Some analysts believe that a massive sell-off would be counterproductive for China, as it would affect the value of its remaining assets. However, other experts warn that if the trade war continues to escalate and economic interdependence breaks down, China might be willing to accept some losses to pressure the US financial system. The Trump administration's tariff strategy could be pushing Beijing to resort to its most powerful option. Recent Chinese government actions, such as directing banks to curb dollar purchases, may be part of a calculated plan to weaken the global role of the US currency. China might also be diversifying its reserves as protection against sanctions, promoting alternatives such as its digital currency. These actions may not just be threats but elements of a long-term strategy. Meanwhile, the US stock market is already suffering from the effects of these geopolitical tensions. Just the rumors of a potential bond sell-off triggered waves of uncertainty among investors last week, intensifying the selling frenzy. Investment funds, which typically view bonds as a safe haven, are now quickly pulling back, concerned about a potential rise in interest rates, inflation, and a drop in bond values. These events have caused great volatility in the market, with the dollar under pressure. Meanwhile, Trump maintains a defiant message, asserting that they will win the trade war through tariffs. Yet, there have been hints from Washington of a willingness to negotiate with Beijing, possibly signaling a shift. Experts point out that if China begins to offload its bonds, it could severely impact the US debt structure, forcing rapid concessions from the government. Despite these risks, neither power shows signs of yielding. China's bond sale has been described as its strongest move, though it is not its only option. Additionally, it could support other maneuvers, such as expanding the use of its digital currency or promoting local currency transactions within Asia. Although the bond sell-off is a powerful tool, it is not China's only weapon. However, concerns are growing in Washington about the impact a massive sale would have on the US economy. Social media is buzzing with speculation about Trump panicking, reflecting fears about the political consequences in the United States. Some lawmakers are already warning the president that continuing to escalate the trade conflict could have devastating effects on the economy. The economic community remains divided on the potential impact of such a move. Although China holds between $900 billion and $1 trillion in US bonds, the market is large enough to absorb the shock, although a sudden sale would cause a temporary spike in interest rates and impact the dollar. In turn, this would also harm China by devaluing its remaining reserves. Some economists believe China may be planning to sell only a limited portion to send a clear signal to the market. While such an action would not be catastrophic by itself, it could escalate tensions between the two countries. The White House has warned that this move could trigger financial sanctions, but Beijing seems to be preparing for a scenario similar to the one Russia faced following sanctions after the Ukraine conflict. Therefore, China is considering gradually reducing its dependence on US bonds, diversifying its portfolio, and exploring other currencies. In the long term, this could weaken the US leadership in the international financial system. On social media, speculation is growing that this trade war could hinder global growth, raise inflation, and reduce demand. Some even argue that, in the long term, China could benefit from Trump's tariff strategy if it succeeds in redirecting investment to other Asian markets. Despite Trump's attempts to moderate the tariffs, markets remain uneasy. Bond market instability continues to reflect a growing financial fragility. According to Reuters sources, current analyses highlight how China once considered U.S. Treasury bonds the safest destination for its trade surpluses. However, with the deterioration in relations between the two powers, that trust has eroded. Today, the big question is what will happen if China definitively withdraws from the U.S. bond market. This uncertainty is also worrying other major holders of U.S. debt, such as Japan and some European countries, who fear being dragged into the potential turmoil. An increase in U.S. interest rates would have significant effects on global capital flows, possibly driving investors to seek more stable markets. This would not only impact the relationship between China and the United States, but also the broader global economy. Many are now wondering whether we are on the brink of a new crisis. Historically, the combination of trade conflicts and financial instability has often been the prelude to global recessions. Some experts draw parallels to the protectionist policies of the 1930s that led to the Great Depression. Although today's technological landscape is different, the current uncertainty should not be underestimated. In recent statements, former President Trump said that China wants to negotiate but doesn't know how to start, and that they are waiting for a call. This statement suggests a possible opening toward dialogue. However, on social media, many wonder whether this is a genuine willingness or just a strategy. Beijing, for its part, has reiterated its position. Remove the tariffs, and we will do the same. But if negotiations fail, China might resort to its ultimate card, selling US bonds. The magnitude of that operation will be decisive. Will they sell all their reserves or proceed gradually, unloading billions per day? In either case, the effect could be severe, destabilizing the dollar, raising interest rates, and pushing the United States closer to a recession. If you enjoyed the video and would like to continue learning about technology and markets, subscribe to Data Dollar and leave a like. See you next time.